The finance internet spends every single day arguing about the same handful of public stocks. Nvidia, Tesla, Apple, the same tickers recycled across 10,000 videos. And while everyone fights over the companies you can already buy with one tap, the single most valuable private company on the planet is quietly compounding in a way that almost no retail investor is positioned for. SpaceX, not publicly traded, not in your index fund. And depending on what happens in 2026, possibly the most important investment story of the decade that most people will completely miss. Let me be clear about something up front, because it matters. You cannot open your brokerage app and buy SpaceX stock today. It is privately held. That single fact is exactly why this is worth understanding now, before the door opens, rather than the day everyone rushes through it at once. Here's what the numbers actually show. As of the most recent private tender offers, SpaceX has been valued at roughly $350 billion, with later transactions reportedly pushing it higher. To put that in perspective, that valuation makes it more valuable than companies like Coca-Cola, more valuable than McDonald's, more valuable than the vast majority of the S&P 500, and it has never sold a single share to the public. It got there entirely through private capital and retained dominance. That is not normal. That is a company the market has decided is too valuable to stay private much longer. And there's a deeper pattern here worth naming, because it explains why this matters to you specifically. A generation ago, companies went public early and small. Amazon's IPO valued it at under $500 million in 1997, which meant ordinary investors captured almost the entire run from there to over $1 trillion. Today, the most valuable companies stay private far longer, raising enormous sums from venture funds and sovereign wealth before retail ever gets a look. The growth that used to happen in public, where anyone could buy it, now happens behind a closed door. SpaceX is the clearest example alive. By the time it lists, much of the easy multiple may already be captured in private. Understanding that dynamic is the difference between informed positioning and showing up late. This isn't hype, it's structure. And the structure is built on two engines that almost nobody separates correctly. Reason 1, the launch business is already a monopoly, and monopolies print cash. Most people think of SpaceX as the rocket company, the dramatic landings, the Mars talk. But strip away the spectacle and look at the market position. SpaceX, through Falcon 9 and its reusable booster, now launches the overwhelming majority of all mass that humanity puts into orbit. In recent years, it has accounted for more than 80% of the payload mass reaching orbit globally. Not 80% of American launches. 80% of Earth's launches. Look at the cadence, because cadence is the tell. SpaceX has flown well over 100 orbital missions in a single year, a launch roughly every 3 days, while most national space programs manage a handful annually. No competitor is close. The reason is boring, and it's the most important word in investing: cost. Reusability took the price of getting a kilogram to orbit and collapsed it from tens of thousands of dollars in the old expendable rocket era toward the low thousands and falling. When you can land and reuse the most expensive part of the rocket, your marginal cost per launch falls to a level competitors using throwaway rockets cannot mathematically match. That is the definition of a durable moat. Competitors are years behind, and every year SpaceX flies more, the lead compounds. A business with 80% market share, a structural cost advantage no one can replicate quickly, and a customer list that includes NASA, the Department of Defense, and nearly every commercial satellite operator, is not a science project. It is an infrastructure monopoly. And infrastructure monopolies are some of the most valuable assets that exist, precisely because everyone else has to pay the toll to use the road they built. Reason 2. Starlink is the part that changes everything, and it's a recurring revenue machine. The launch business is impressive. Starlink is the reason the valuation makes sense. Here's the distinction that matters. Launch is lumpy, contract-based revenue. Starlink is recurring, subscription revenue, the kind of revenue Wall Street pays the highest multiples for in the entire market. $1 of predictable monthly subscription income is valued far more richly than $1 of one-off contract income, because investors can forecast it, model it, and trust it to recur. Starlink is the satellite internet network SpaceX built, using its own launch advantage, putting thousands of satellites into low Earth orbit. By 2025, it had grown to well over 4 to 5 million subscribers across more than 100 countries, with a reported revenue run rate climbing into the range of $8 to $10 billion a year. And crucially, it crossed into cash flow positive territory. Read that again. A satellite internet company that did not meaningfully exist 6 years ago is now generating billions in recurring annual revenue. Run the simple math. Millions of subscribers, each paying a recurring monthly fee, plus hardware, plus premium and enterprise and maritime and aviation tiers that pay far more. And you get a revenue base that grows every quarter the constellation expands. And it has a flywheel almost nobody else can build. SpaceX launches Starlink satellites on SpaceX rockets at SpaceX's internal cost. No competitor gets to launch their network for a fraction of the price, using their own monopoly launch provider. The cheaper SpaceX makes launch, the cheaper it deploys Starlink, the more revenue Starlink throws off, the more it can reinvest in launch. Each engine feeds the other. Then there's direct-to-cell, beaming connectivity straight to ordinary smartphones in dead zones, partnerships with major carriers, and a total addressable market that is effectively every human on Earth without reliable internet. That's billions of people. When analysts model SpaceX's valuation, the majority of it is increasingly attributed not to rockets, but to Starlink, valued like the high-growth recurring revenue tech business it actually is. Reason 3. 2026 is shaping up to be the catalyst year, and catalysts are when private value becomes public price. So why does the specific year matter? Because the single most discussed event in this entire story is the potential public listing of Starlink. SpaceX leadership has repeatedly signaled that Starlink could be spun off and taken public once its revenue and cash flow are predictable enough, and the financial profile has now reached exactly the kind of maturity that historically precedes a major IPO. A Starlink IPO would be one of the largest technology public offerings in history. It would put a hard public market price on the crown jewel asset, and it would, for the first time, give ordinary investors a direct, liquid way to own a piece of this story. The years before a listing like that are typically when the asset re-rates, when private valuations climb in anticipation, which is exactly what we have watched happen in each successive funding round. On top of that, you have Starship moving toward operational cadence, which unlocks even cheaper launch, even heavier payloads, and even faster Starlink deployment. The pieces are converging on the same window, and that convergence is why so much attention is fixed on the next 12 to 24 months. Now, here is the part the hype videos will never give you, and it's the part that actually protects your money. Because how you could get exposure, and the risks of doing it, matter more than the excitement. The honest truth about access: you have limited imperfect routes, and every one of them has a catch. Route 1, the pre-IPO secondary market. Platforms exist where shares of private companies change hands before any IPO. The catch: these are generally restricted to accredited investors, meaning income or net worth thresholds most people don't meet. The minimums often run into the tens of thousands of dollars. The shares are illiquid, and you're frequently buying through special-purpose vehicles that layer in fees and take a cut of your upside. Route 2, funds that hold SpaceX. A handful of publicly traded or semi-public funds hold SpaceX in their portfolios, which gives indirect exposure that an ordinary investor can actually buy. Certain venture-style funds and a small number of mutual funds carry a SpaceX position and mark its value periodically. The catch, and this one is critical: some of these vehicles have traded at enormous premiums to the actual value of what they hold. There have been cases where a fund holding private names like SpaceX traded at well over double, in some moments several times, the net asset value of its underlying holdings. When a fund that owns a slice of SpaceX trades for far more than that slice is worth, you are not buying SpaceX at a fair price. You are buying hype at a markup. And that gap can collapse without warning and take your money with it even if SpaceX itself does nothing wrong. Route 3. Simply wait for the Starlink IPO. Patient, boring, and for most people the most rational path. You get a liquid, regulated, transparent way to buy in, with real audited financial disclosures instead of guesswork. The catch: there is no guaranteed date, no guaranteed price, and IPOs frequently open expensive, punishing the people who buy on day one out of fear of missing out and then watch the price drift down for months as the hype unwinds. And that brings us to the risks, because no investment thesis is honest without them. SpaceX is concentrated around one founder whose attention and decisions drive the entire enterprise. That is real key person risk, and it cuts both ways. The valuations are set in private rounds, not by an open market, so they can be optimistic and they can reset downward as easily as they climb. The space sector is capital intensive and faces regulatory, technical, and competitive threats. And a single catastrophic failure, a grounded fleet, or a regulatory fight over spectrum can change sentiment overnight. And private illiquidity means that if you do get in early through a secondary, You may not be able to sell when you want, at any price you like. None of this is a reason to ignore the story. All of it is a reason to approach it with your eyes open instead of your emotions running the trade. So what do you actually do with all of this? The boring discipline beats the FOMO every time. First, get educated now, position later. The single biggest mistake people will make is paying no attention until the IPO headline hits, then buying at the most expensive, most emotional moment possible. The informed investor studies the routes, the valuation, and the risks during the quiet period, exactly the period we're in right now. Second, if you ever pursue indirect exposure through a fund, check what it actually owns and what premium you're paying over that value. A fund trading at a large premium to its underlying assets is a trap dressed as an opportunity. Never confuse owning the ticker with owning the company at a fair price. The price you pay determines your return more than the quality of the company ever will. Third, size it like the high-risk, high-uncertainty position it is. Whatever you eventually decide, a private, illiquid, single-company space bet is not where your emergency fund or your core index portfolio belongs. It's a satellite position, no pun intended, around a boring, diversified core. The people who build real wealth don't bet the foundation on a moonshot. They build the foundation first, then let a small, deliberate allocation chase the asymmetric upside, an amount they could lose entirely without it changing their life. Here's the bottom line. SpaceX is, by the numbers, an infrastructure monopoly in launch attached to one of the fastest-growing recurring revenue businesses in technology, sitting at a valuation that already rivals the largest public companies, all while still private. 2026 is the year the catalyst, a potential Starlink listing, could finally turn that private value into a public price the rest of us can access. The opportunity is real, so are the risks, and so is the markup that punishes the impatient. Most people will hear about this for the first time on the day of the IPO, and they'll buy at the top because everyone else is. You're hearing about it now, with the data and the risks laid out, while it's still boring. That head start is the entire advantage. So here's my question for you. If a Starlink IPO opened tomorrow, would you buy on day one, or would you wait for the hype to cool and the price to settle? Drop your answer in the comments, because that single choice tells me more about your investing temperament than anything else. If this gave you a framework you didn't have before, share it with one person who keeps asking how to invest in SpaceX. And subscribe, because next week we're breaking down how to actually evaluate a company before an IPO, the exact checklist that separates a real opportunity from an expensive story.